Hi there. In this video, we will shift the gear from talking about consolidation among two corporate, like parent and subsidiary, to partnership. In brief, if you remember the first part of this course, we were talking about consolidation between a parent company and subsidiary company where the parent can own either 100% or controlling interest, and whether the book value is equal to the fair value or the fair value is higher. And then we shift the gear into the intercompany transactions. So we said the parent company can make some transactions with the subsidiary, such as selling inventory or providing services or providing fixed assets. And then we said, how about if a corporation is located in a different country than the subsidiary? Then we face the issue of the foreign currency exchange. And the last part of this course is talking about partnership in this chapter and in the next chapter. In this chapter, we talk about four main areas. First, how we can start a partnership. Then, how we distribute the income between two partners. And then, how can we accept a new partner? And how can we retire an existing partner? And everything is covered legally in the Uniform Partnership Act, which is located on Brightspace. It's a long document that explains the legal side for the partnership. So first, let us have a brief introduction about the definition of the partnership, the legal side, and then we go through the other parts of this presentation. So let me share the screen here. Here we go. So what is a partnership? We say a partnership, it's a gathering of two or more, either individuals or corporations or other partnership. So the partner in a partnership doesn't have to be an individual. It could be a company. And they come together not as agent, but as owner. And not to go for a charity, but they have to look for profit. So the main purpose of a partnership is to make profit. So the minimum number of partners is two, but there is no maximum number. So a partnership can have 1,000 partners or 1,000,000 partners. There is no maximum for the number of partners. The partnership is so easy to start. For a corporation, we need to fill out an application and submit it to the SEC to get the approval for the starting to issue shares. But for partnership, it's easy to start. It's very good for two or more people who have different skills or talents to work out together. It's separated from the owner. In what way? The partnership has to complete 1065 tax form and submit it to show the profit, but doesn't make any tax on the income. Rather, it gives the income to the individuals, and the individuals, they pay the tax. So legally, the company is separated from the owners. It can use a different basis in accounting, either the accrual basis or the cash basis or the modified cash basis. The partnership, it's regulated by the state government. And most of the states, they use the Uniform Partnership Act, which, as I said, it's made, I put it on Brightspace for you to go through if you are interested to know more about the regulations for partnership. The Uniform Partnership Act mainly covers the relation of the partners with one another and with the outsiders. And also, it talks about how to accept a new partner and how to retire an existing partner and how to stop the business completely. What are the advantages of a partnership? We say it's easy to start. By even a handshake and verbal commitment, we can start a partnership. And it doesn't have any formality. So we can make our contract either long or short. So it's not regulated as the corporation. The partnership doesn't pay tax on the income, but rather it gives the income to the partners and they pay the tax. The disadvantage of partnership, it's unlimited liability, which means if the company fails to pay the creditors can claim their money from the personal assets of the partners. Also, it's difficult for a partner to leave the company without the approval of the other partners. And mutual agency, it means every partner is a representative for the company. Which means if the partner made a wrong decision, excuse me, the whole company is bound by that decision. Excuse me. How we start a partnership? We say it could be informal, like handshake, verbal commitment, or it could be formal. The contract for a partnership should have the name of the company, the name of the partner, the type of the business, the capital contribution, the way we should divide the profit or the loss, the procedure used for partnership changes, whether admission of a new partner or withdrawal of an existing partner, and other aspects. What are the journal entries when we start a partnership? We usually debit all the assets at the fair value, all the liabilities at the fair value, and then the difference will go to the partner's capital. So I made an Excel file that has different examples, some of them about the journal entries for those partnership, and then some distribution of income, some exercises for the admission of a new partner, and finally, the withdrawal of an existing partner. So here we see 4 partners. They came together, apple, banana, cat, and dog. And this file, by the way, it's there on Brightspace. You can check it out to know how to resolve the problem. Again, as I did in my previous presentation, I encourage you to put my video on hold, try to answer the example, and then come back to the video to see how I answer the example. So Apple came with some assets, as you can see them here. Banana is the same, cat and dog. All of them, they have some assets with a fair value or liabilities like mortgage payable or not payable. But we have also the tax basis for those assets and the difference. In partnership, we don't need to worry about the tax or the difference. Everything is recorded at the fair value. So how do we record it? We make one journal entry for all the 4 partners. So for example, you say, how did you get this cash? I simply added all the cash for all the 4 partners. So here I get the cash here, plus this one, plus the third one, plus the last one. So the amounts that you will see it here, it's the total from all the 4 partners. But remember, Apple provided building, but nobody else provided building. So I will take 60,800 and put it here. So if one partner provided the asset, we will put it here. If it's more than one partner, we add the assets. We do the same for the liability. We have notes payable here, and we have notes payable here. So we add the 2 notes payable. So we put their total here, and then the mortgage. The last one, I'm sorry, it should be like apple, banana, cat, and dog. So these names I had it by mistake, but here we go. And we try to find the partner capital. So the name, it should be Apple capital. Okay. How do we get the 32,800? 800? We add the assets minus the liabilities, and we get 32,800. So to get the capital of every partner, you get the assets minus liability. In the last one, there is asset but no liability. So we just add them. And this would be the model answer for the first exercise. Again, put my video on hold, try to do the answer by yourself and come back to check the answer. Now let us move to the second exercise. In this exercise, we assume the partnership is running, but we need to divide the income between the two partners, Apple and Banana. Apple and Banana, they form the partnership, and here is their capital, 54 and 36. Each partner is eligible to receive 10% on their average capital. Okay, and then every partner is eligible to receive salary. So we have salary here for both partners. The remaining will be divided between 70% to Apple, 30% to Banana. So what we usually say, how much income? In the exercise, it says, try to distribute the income of 97 between the two partners and 31 between the two partners. So let us take a look on the first one. We said that we will divide it by 70 to 30. The average capital here, we have it 54 and 36. It's only one capital. The net income is 97, so I put 97 here. Then we said, how we get the interest? We say it's 10%. So we multiply 54 by 10%, and then 36 by 10%. Then we add the salary, which is 27 and 15. And then we subtracted it from the income. So the residual income, 45,500. We divide the 45,500 by 70% to Apple, 30% to Banana. And then we add them. When I say we add those numbers. Excuse me. We add the interest on capital, the salary, and the allocation. How about 31,000? In 31, we leave the first part as it is, this one here, except 97, I will put 31. So when I put 31 and I make my calculation as I did here, 9,000 salary, 9,000 interest, 42 salary, I end by residual loss or deficit. Then I divide the deficit between them, and then I add 5,400 plus 27,500 minus 14,350, and then I get the income. So this way shows you how to distribute the income or the deficit between the partners. Now let us move to the third one. And the third one, I didn't give you the income only, but I give you the whole income statement, which is here. What do we need from the whole income statement? I need only the net income, 73,000. And here we have the beginning capital, 49,800 and 117. But during the year, Black added capital on April 1st and White added capital on August 1st. So how can I calculate the average here? I take the capital, the additional capital, and multiply it by 9/12. Because from the 1st of April until end of December, 9 months. But for White, I will multiply it by 5/12. Because between August 1st and December 31st, 5 months. So we do it this way. We add the capital here, which is coming from the beginning of the year. I add 49 plus 24,300. So if I multiply 49,800, and here I multiply 24,300, multiply this one times 9/12, and then we add this one plus this one, and then we multiply this one. He said how much? The interest is 6% here on the average capital. So I multiply this one times 6%. I get 4,082, which is here. This one, I put it. The same thing for the white. We get the beginning capital, then we get the additional capital, which is in our situation 21, multiplied by 5/12, then add it and multiply by 6%. You get the average here for one. Then the company decide to give bonus to the second partner, which is here, the bonus 10%. So we take the remaining balance, which is this one, multiplied by 10%, which is here, then subtract. Then we get the residual income 55,236. We need to divide it by 70 to 30. So I put it here, 70 to 30 from the 60. And then we add all these numbers, we get 39, and here we get 39. In the second situation, it says, or the second requirement, how can we take the distribution of income and create another report? We call it a statement of partners' capital, which is retained earnings in corporation. So we start by the beginning capital, which is 49,800 and 117. And we take the additional capital, 24,300, which I got it from here, 24,300 and 21,000. So we get it here. And then we get the portion of the net income, which is in our scenario, 39,584 and 33,416. Then we add them. And here also we add them, we get the total. Minus withdrawal. In the example, you will see here, they get withdrawal 600 weekly. So I take the 600 multiplied by 52 weeks. We get 31,200. And then we subtract it, we get the ending capital for each one. In the last requirement, it says, how about if we make the salary 32 and 25, 536. So we start by 73. So here I started by 73, and here I get 73. Here I have 11,627, here also the same. The bonus also 6,137, and it's here 6,137. The only difference will be here in the salary. So because the salary is too big, I end by loss. But how we distribute the loss? If you remember, it says if we have profit, 70 to 30. But if we have loss, 50-50. So I took this one and I divided 50-50. And then I added to get the amount. In the fourth exercise, here we talk about admission of a partner. And in this admission here, we have apple, banana, and carrot, and they have their capital, and this is their total capital. And then they decide to accept tomato, and tomato will take 1/3 of the capital. So how do we get this 1/3? We take the 424, which is like 2/3, and we need to convert it to 3/3. So what shall I do? I took 424 multiplied by 3/2, as you can see it here. Okay, so why? Because it's like cross multiply. If you multiply 300 424 times 3 over 3 over 2 over 3, you will get 636. From this one, we need to multiply it by 1/3, we get 212. The second scenario, it says, how about tomato will pay 80,500 and will get 20%. So again, we take 424 as we did here. Here I said 424 will be 2/3. Here 424 will be 80% because he needs to take 20%. So how much is 100? We multiply 424 times 100 over 80. We get 530. We multiply 530 by 20%. We get 106. But he paid 80,500. So here, the difference between them is goodwill. I'm sorry for my bad voice, but I cannot help it. And I hope you are patient with me in my recording. The third one, we said, how about if tomato is investing 202, but the capital will be 626. What does it mean? I was able to calculate the capital here and here, but in the third situation, he said, no, take the capital 626 and give him 20%. So I did it. So the capital now for tomato is 125, but we made here 20%. So he paid 202, but his capital is 125, 200. So how much is the difference between those two amounts? 76,800. How can I distribute 76,800 between the three partners? We said here, we distributed by this ratio, if you are able to see, 6 to 3 to 1. So I divided here 6 to 3 to 1, and I got this ratio. The next one is exercise 5. It talks also about the admission, but we have two partners here with their capitals, and a third partner came to buy 50% from Banana Company. If the transaction goes between two partners, the company doesn't need to worry about the difference. So we take half of Banana Capital, 80,000, and we debit Banana Capital, credit Carrot. But what about the 99? I don't care about it, because this amount goes to the partner, not to the company. The second one, Carrot paid for 1/3. So we add the capital of the two partners, 360, which will make 2/3. So how much it will be? 3/3. We multiply 630 times 3 over 3 over 2 over 3. We get 540. Then from the 540, we need to take 1/3, which is 180. And we debit cash, credit capital. The third one, Carrot paid 100 for a 25% interest. So we take 360, which is 75, because he took 25. Then how much is 100? We multiply 360 times 100 divided by 75, we get 480. From the 480, we need to multiply by 25%. So we get 120. But he paid 100, so the difference between 100 and 120, 20,000, which is a good one. The last one is Apple and Banana. They had some inventory, they want to remove it. So we take the 100,000, which is 25%, and divide it by 25%. Why I do that? Because I say if 100,000 is 25%, how much is 100%? Same as we did before. So we take 100 times 100% divided by 25. We get 400. But if I add the capital of the partners 200,000 plus 160 plus 100, which is coming from carrots, we get 460. So how much is the difference between 400 and 460? 60. So I need to divide 60 between apple and banana. And the ratio is here, 3 to 2. So we get 3 to apple, 2 to banana. And here we debit cash credit carrot by the 100,000. The next one, exercise number 6. And here we see that there are 3 partners, apple, banana, and carrot, but carrot decides to leave. So what shall we do? We have 3 different situations, but you need to remember that carrot has a capital of 31,900, and he will take 39,600. So here, 39,600, which is going to take, but his capital here, 31,900. So how much is the difference between them? 7,700. So now they have the ratio 4 to 1 to 1, but carrot is leaving. So we have 4 to 1. So here we have 4 and here 1. So their total is 5. So we have 4 over 5 and 1 over 5, which I put it here. So you multiply 7,700 times 4 over 5 and here times 1 over 5, you get those 2 amounts. The second situation, we say, what about if carrot received 43,400, but still his capital 31? So here we put 43,400 and 31,900. The difference between them is goodwill. The last one is getting 34,700, which is here. But we say the difference is all implied goodwill. We say, how do we calculate all implied goodwill? Subtract 34,700 minus 31,900. This one, it's the goodwill to carrot. And if you remember, we say it's 4 to 1 to 1. So their total is 6. And then we have 4 over 6, 1 over 6, 1 over 6. So if 1 over 6 is 2,800, I think the other one is going to be 2,800. And then the last one is going to be 4 times, which is 11,200. So I put them here, 11,200, 2,800, and 2,800. Their total is 16,800. In another way, if you take 2,800 times 6, you will get 16,800. The last exercise, which is here, we have also apple, banana, and carrot is leaving. So we say, what will happen if carrot receive some money from banana without going to the company? Then we remove the capital of carrot, 120 to 100, which is here. And then we credit banana by the capital, and we don't care about the cash, 150,700. Why? Because the transaction goes between partners without passing to the company. The last one is the goodwill. So here he's going to take 151,700, which is here. And the difference between 151,700 and his capital 120,200, the difference is 31,500. The same way I did it, if 31,500 is his portion, and the ratio is, I think, 6 to 3, 2 to 3 to 5. So here we have 2, 3, 5, which is total of 10. So we get 2 over 10, 3 over 10, 5 over 10. If 5 over 10 is 31,500, how much is 3 over 10 is going to be? Well, 600. And 2 over 10, 18,900. So to make it easy, if you take 31,500, multiply it by 2 because it's 50%, 50 plus 50. So you multiply it by 2, you get 63,000. You get debit goodwill, credit all the capital, and this is what we mean by implied goodwill. Again, I apologize for my voice. If you feel any point is still unclear, feel free to reach out, and I hope you do well in the assignment. Thank you. Bye-bye.